Welcome to today's video on a critical investment warning that you simply can't afford to ignore. As of my recording date, February 10, 2023, we've seen numerous all-time highs in major stock market indices around the world, with the S&P 500 reaching an impressive milestone of over 4,800 points for the first time ever. But here's the thing, just because your investments are at or near all-time highs doesn't mean they can't go up in flames. And that's exactly what we're going to explore today. We're living in a market environment where irrational exuberance is often justified by the greatest of all time narratives. You've got pundits saying this is the most stable market ever, with some even predicting a never-ending bull run. However, I'd like to share with you a critical warning sign that suggests otherwise, one that's directly related to a single word: inflation. Inflation, or more specifically, rising interest rates and subsequent inflation expectations, has been quietly eroding the value of many investments since the COVID-19 pandemic began in early 2020. It started with an aggressive monetary policy response from central banks around the world, which led to unprecedented money printing, think trillions upon trillions of dollars worth of new money flooding into economies that were already fragile. By mid-2022, it became clear that this inflation-driven environment was starting to impact asset prices in a big way. On June 13, 2022, the U.S. Federal Reserve raised interest rates by 0.75 of a percentage point for the first time since 1994, and from there on out, it's been a wild ride. Now, you might be thinking, what does this have to do with all-time highs? Well, here's the thing, when inflation expectations are high, investors tend to favor assets that historically perform well in such environments. And what are those assets? Generally speaking, commodities, gold, silver, oil, and agricultural products, as well as real estate and currencies that typically hold their value during periods of high inflation. But there's a catch. While these assets may do well in the short term due to inflation expectations, they can also become increasingly volatile. And it's precisely this type of volatility that has led many investors to lose significant sums over the years, often without even realizing it. Let's take gold as an example. In 2008, when the global financial crisis was at its peak, gold shot up to nearly $1,000 per ounce. Fast forward to 2013, and after a brief correction, gold continued to rise, eventually reaching a high of over $2,100 per ounce in August of that year. However, from then on out, it's been a steady decline, with some minor corrections along the way. Now, you might be thinking that the same can't happen again. But here's the thing, history is repeating itself. Today, we're seeing similar patterns emerge in other assets as well, like Bitcoin and Ethereum, which have both seen significant price drops since their all-time highs in November 2021. Let's now move on to another critical warning sign that you can't afford to ignore: overvaluation. As of my recording date, the U.S. stock market is trading at a staggering 25.5 times its trailing earnings, an all-time high. This means that for every dollar a company earns, it's being valued by investors at $25.50. Now, I'm not saying this can't happen in a healthy bull run, however, what's concerning here is the pace and extent of this overvaluation. Take Amazon, for example, one of the world's most valuable companies. In February 2020, just before COVID-19 took hold, its forward price-to-earnings, P/E, ratio was around 32 times earnings. Fast forward to my recording date in February 2023, and that P/E has ballooned to a staggering 65.4, an increase of over 100% in just 3 years. This kind of overvaluation is exactly what we saw leading up to the dot-com bubble and the subsequent financial crisis. When investors are willing to pay such high multiples for companies with questionable growth prospects, it creates a massive mismatch between supply and demand in the market. In reality, this can lead to two potential outcomes: either these companies will continue to defy gravity and grow at an incredible pace, or they'll collapse under their own weight. And what's often lost on investors is that even if the company itself doesn't go bankrupt, its shares may still plummet due to lower demand or increased competition. Let's move on now to our third warning sign: unsustainably high margin expansion. Many companies today are reporting remarkable profit margins, often much higher than their historical averages. Take Tesla, for instance. In 2020, the company reported a net income margin of around 10%, which was already a staggering increase from its previous low point in 2018. But since then, it surged to an astonishing 15.3%, as of my recording date. Now, at first glance, this might seem like great news for investors. However, there are several red flags here that we should be concerned about. Firstly, when companies report high margins, they often do so by cutting costs, such as employee wages and benefits, or reducing their research and development budgets. Secondly, these high margins can create a false sense of security among investors. We've all seen it happen before. Companies become complacent with their current market position and fail to innovate or expand into new areas. And when this happens, it's only a matter of time before the inevitable correction hits, often with a severe impact on their share price. Our fourth warning sign is excessive leverage. In the last few years, many companies have taken on unprecedented levels of debt to fund their growth strategies. This might seem like a clever move at first glance. After all, who doesn't love a good return on investment? But here's the thing: when interest rates are high, it becomes much harder for these companies to service their debts. Take the airline industry as an example. Between 2020 and 2022, major carriers like Delta Air Lines and American Airlines took on massive amounts of debt, often to finance new aircraft purchases or expansion plans. However, with interest rates soaring in recent times, it's become increasingly difficult for these companies to service their debts. And what happens when they can't? Well, it's usually a messy outcome. Think bankruptcy, share price collapse, and significant job losses. So while excessive leverage might seem like a clever way to boost short-term earnings, the long-term consequences are often devastating. Last but not least, let's discuss our fifth warning sign: an overly optimistic consensus view. When investors have high expectations for future economic growth or specific industries, it can create a self-fulfilling prophecy. Take the Great Rotation of 2013, when many experts predicted a shift from bonds to equities due to rising interest rates and inflation expectations. While this did indeed happen in the short term, what followed was an even more severe correction, with bond prices plummeting and equity markets experiencing significant volatility. The same is happening today, albeit in different asset classes. For instance, we're seeing unprecedented levels of enthusiasm for renewable energy stocks and electric vehicle manufacturers. But here's the thing: while these sectors have tremendous growth potential, they also come with unique challenges that investors often underestimate, such as supply chain disruptions, high production costs, or regulatory hurdles. Now that we've explored all 5 warning signs in detail, let's take a step back and look at the bigger picture. As I mentioned earlier, this is not just about avoiding an investment trap, it's also about understanding what drives these warning signs, namely, human psychology. Investors tend to follow the crowd, whether they're buying or selling assets. And when everyone thinks the same thing, markets can become incredibly volatile. This is precisely why so many investors lost their shirts during the dot-com bubble and the 2008 financial crisis, despite being experts in their field. However, this also means that there's an opportunity for you to learn from history and avoid these pitfalls. So what should you do? Here are a few takeaways. 1. Understand your own risk tolerance and investment goals before entering any market. 2. Be cautious when investing in overvalued assets or those with unsustainable growth prospects. 3. Diversify your portfolio to minimize exposure to individual sectors or industries. 4. Monitor your investments regularly for signs of excessive leverage or declining profitability. 5. Finally, stay informed but avoid being swayed by consensus views. Do your own research and think critically.